Imagine holding $10,000 in your hands. What if this sum could be the key to your financial freedom? How would you make it work for you? Right now, you have two choices: spend it on things that lose value or use it to build real wealth. The right investment decisions today could change everything about your future. But how do you invest wisely without making costly mistakes? That's what we're about to break down. It'll walk you through a step-by-step plan to help you make the smartest moves with your first $10,000. Follow these steps, and you'll set yourself up for long-term success. Step 1. Establish a strong financial base. Before jumping into the world of investments, the first step is making sure you have a solid financial foundation. The best investment strategy won't matter if you're constantly worrying about money emergencies. Unexpected expenses can come out of nowhere: a sudden medical bill, car trouble, or even a job loss. To avoid panic selling your investments when life throws a curveball, you need an emergency fund. A high-yield savings account is the best place for this, keeping your cash safe but still earning a little interest. A good rule of thumb is to set aside at least 3 to 6 months' worth of living expenses before making any investments. The next thing you need to do is clear any high-interest debt. It doesn't make sense to invest in something that grows at 7 to 10% per year if you're losing 20% to credit card interest. That's like filling a bucket with water while there's a hole in the bottom. If you have credit card balances or high-interest loans, pay them off first. Once that's done, you're in a position to let your money grow without unnecessary financial stress. Step 2. Define your investment objectives and risk appetite. Before putting a single dollar into the market, you need to know what you're investing for. Are you planning for retirement? Saving for a house? Looking to build long-term wealth? Every investment decision depends on your personal goals. A clear target helps you decide how much risk to take and which investment vehicles make sense for you. Speaking of risk, this is where many new investors go wrong. Some people take on way too much risk, expecting to double their money overnight. Others are too scared to invest at all, letting their cash sit in a savings account losing value to inflation. The key is finding a balance that matches your comfort level. If you don't like the idea of market swings, a conservative approach with bonds and index funds might be better. If you're okay with some volatility for higher potential returns, stocks and ETFs could be the way to go. Step 3. Explore investment vehicles. There are several ways to invest your money, but not all of them are created equal. One of the best places to start is a retirement account. If you have access to a 401k through your employer, take advantage of it, especially if they offer a matching contribution. That's free money, something you never want to pass up. A traditional or Roth IRA is another great option, giving you tax benefits while growing your wealth. If you want more flexibility, a taxable brokerage account is another option. Unlike retirement accounts, there are no restrictions on when you can withdraw your money. This makes it perfect for long-term investing without the limitations of retirement funds. Step 4. Diversification strategies. Investing all your money into a single stock is like betting everything on one horse. It might win big, but the risk is massive. Instead, spreading your money across different investments reduces risk while keeping growth potential high. One of the easiest ways to do this is by investing in ETFs or index funds. These funds track entire market sectors, meaning you get exposure to hundreds of companies with a single investment. For example, an S&P 500 ETF invests in 500 of the largest companies in the US, offering instant diversification. Balancing different types of assets is just as important. A good mix of stocks, bonds, and even real estate investments can protect you against market downturns. Stocks provide growth, bonds offer stability, and real estate can generate passive income. Finding the right mix depends on your risk tolerance, but the key is not putting all your eggs in one basket. Step 5. Investment strategies. Timing the market is a losing game, even for the pros. Instead of trying to buy low and sell high, a smarter approach is dollar-cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. By doing this, You automatically buy more shares when prices are low and fewer when prices are high. Over time, this smooths out the impact of market volatility and keeps you from making emotional investment decisions. Reinvesting dividends is another strategy that can significantly boost your returns. Instead of taking dividend payments as cash, use them to buy more shares. This creates a compounding effect, where your money keeps growing on top of itself, leading to exponential growth over time. Step 6. Practical steps to begin investing. Now that you know what to invest in, it's time to take action. Choosing the right brokerage is the first step. Look for a platform with low fees, easy navigation, and access to the investments you want. Vanguard, Fidelity, and Charles Schwab are solid options. If you prefer automated investing, robo-advisors like Wealthfront or Betterment can manage everything for you. Once your brokerage account is set up, deposit your funds. Many beginners hesitate at this stage, but waiting won't grow your money. Even if you don't invest the full $10,000 at once, start with a portion and ease in. If you're using dollar-cost averaging, set up automatic contributions to stay consistent. When selecting investments, stick to your strategy. ETFs and index funds are great for diversification, while individual stocks require more research. If you're interested in real estate but don't want to buy property, consider REITs. The key is to avoid emotional decision-making. Don't chase hype or short-term gains. After investing, resist the urge to check your portfolio daily. Investing is a long-term game, and short-term fluctuations don't matter. Instead, focus on growing your income so you can invest more over time. Step 7. Ongoing portfolio management. Investing isn't a set-it-and-forget-it process. Markets change, and so do your financial goals. That's why it's important to review your portfolio regularly. Every few months, check if your investments are still aligned with your long-term plan. If not, make adjustments accordingly. Rebalancing is another crucial step. Over time, some of your investments will grow faster than others, throwing off your original asset allocation. For example, if stocks perform well, they may take up a larger portion of your portfolio than you intended. Rebalancing means selling some of the overgrown assets and reinvesting in underperforming ones to maintain your ideal balance. Investing your first $10,000 isn't just about making money. It's about setting the foundation for financial freedom. Every dollar you invest today has the power to grow exponentially over time, bringing you closer to your biggest financial goals. The steps we covered today, building a strong foundation, setting clear goals, choosing the right investments, diversifying, and staying consistent, are the exact strategies that have helped countless investors build wealth. The best part? You don't need to be a financial expert to make this work. All you need is discipline, patience, and the willingness to get started. If this guide helped you, make sure to like the video, drop a comment with your biggest takeaway, and share it with others who need this knowledge. Don't forget to subscribe to the channel and hit the bell icon so you never miss out on valuable investing insights. The journey to financial success starts now, and the best time to begin is today. That's